You don't lose money because you're bad at picking stocks. You lose money because your brain was never designed for bull markets. The biggest investing mistakes don't happen during crashes. They happen when everything looks safe, when headlines scream new highs, when everyone around you suddenly becomes a market expert. And that's the trap. By the end of this video, you'll understand why intelligent people with six-figure salaries still end up buying high, selling low, and wondering where their money went. Picture this. Your friend made 60% on an AI stock. Your coworker doubled their money in crypto. Your social media feed is full of screenshots showing huge profits. You tell yourself you'll stay disciplined. Then, you buy. Not because the investment suddenly became better, because everyone else already made money. That's the psychology of a bull market. It doesn't just raise prices. It changes how your brain works. And unless you understand these behavioral traps, the market will use your own emotions against you. Here's the first trap nobody tells you about: FOMO. Fear of missing out isn't just a social media problem. It's one of the biggest destroyers of investment returns. Look at what happened during the meme stock frenzy in 2021. Many retail investors rushed into stocks after prices had already exploded. Some companies gained hundreds of percent in weeks, but countless late buyers entered near the top, only to watch prices collapse months later. The opportunity didn't disappear. Your patience did. Markets reward discipline. Your brain rewards excitement. Those are completely different systems. The second trap is even more dangerous: overconfidence. In a bull market, almost everyone starts believing they're a genius. You buy one winning stock, then another. After 3 wins, you don't think you're lucky anymore. You think you figured out the market. Behavioral economists call this self-attribution bias. You credit yourself for the gains while blaming bad luck for the losses. Here's the problem. During long bull markets, even average investments often go up. Rising markets hide bad decisions. It's like driving 120 miles per hour with your eyes half closed on an empty highway. You think you're skilled. You just haven't reached the curve yet. Now here's where it gets interesting. Most people think panic selling is a bear market problem. It's actually created during bull markets. Because the higher your expectations climb, the harder reality hits. Imagine someone invests $20,000 after hearing non-stop success stories. 6 months later, the market drops 20%. Instead of thinking this is normal, they think something is terribly wrong. Why? Because their expectations were built by optimism, not history. The S&P 500 has experienced many corrections of 10% or more throughout its history, yet long-term investors have still seen substantial growth over decades. Volatility isn't a bug. It's the price of admission. The fourth trap doesn't happen in your portfolio. It happens in your lifestyle. It's called lifestyle creep. You get a raise, your investments go up. Suddenly, the nicer apartment feels affordable. The luxury car payment seems reasonable. Weekend spending doubles because your portfolio makes you feel richer than you really are. This is known as the wealth effect. When people feel wealthier on paper, they often spend more, even before those gains are realized. Then the market falls. Your investments shrink, but your expenses stay exactly the same. Now you're forced to sell assets simply to maintain a lifestyle built on temporary gains. This is how bull markets quietly create future financial stress. And I'll admit something. Almost everyone thinks they'll stay rational before they're tested. Then real money is involved, everyone around them is making profits, and suddenly discipline feels much harder than it sounded in theory. So here's what every bull market tries to convince you. That prices only go up. That risk has disappeared. That this time is different. History says otherwise. The market doesn't punish ignorance nearly as often as it punishes overconfidence. Remember this, your biggest investment risk isn't the next crash. It's the version of you that believes crashes no longer matter. If you want to build wealth instead of chasing it, subscribe. Every week, we break down the psychological loopholes that quietly control your money